It is now August 2026, and Uber is operating at the absolute peak of its traditional business model. These milestones include a second quarter with $58 billion in gross bookings and a user base that has scaled to 208 million active consumers. This area graph shows the resulting cash. Over the trailing 12 months, Uber generated more than $10 billion in free cash flow, a first in the company's history. Yet investor confidence has slashed 9% off the stock price during this same period of growth. Wall Street is looking past the present success. Investors realize that the massive human labor force driving these numbers is the exact same asset that limits Uber's long-term profitability. This chart shows the overhead of the human-driven model. Out of $58 billion in total bookings, a $25 billion driver slice goes directly to the people behind the wheel, rather than to Uber's bottom line. Beyond the direct cost of labor, managing millions of human contractors creates constant friction with regulators. This tension recently resulted in an €825 million fine levied by the Dutch Data Protection Authority. The violation involved Uber's reliance on automated software to permanently suspend driver accounts without human review between 2018 and 2022, a direct breach of European privacy laws. While the current network is highly profitable, it is structurally vulnerable. It remains heavily taxed by payouts to drivers and under constant threat from regulators worldwide. To move past these limitations, Uber is using its current cash flow to fund a massive transition towards autonomous vehicles. The plan involves a $10 billion investment to scale autonomous partners across 15 target cities by the end of 2026. Uber is shifting away from the closed, exclusive models of the past. They are winding down their exclusivity deal with Waymo to open their network to a wider range of partners. Uber is a universal aggregator, the central digital hub connecting riders with autonomous vehicles from any manufacturer. We see this global rollout in action, integrating Baidu's Apollo Go in Dubai and launching autonomous rides in Croatia with Pony.ai. CEO Dara Khosrowshahi's strategy focuses on the software rather than the hardware. Uber doesn't need to build the robotic cars. It only needs to control the digital infrastructure that manages them. This push for automation extends beyond the street level. On August 17th, Uber announced a new partnership to bring autonomous drone delivery to Uber Eats. This includes a strategic investment in Zipline, with the ambitious goal of reaching 1 million daily drone deliveries by the end of 2029. For an automated future to be profitable, Uber needs extreme geographic density. They need as many customers as possible using the app before the human drivers are phased out. This search for density explains the $14.8 billion acquisition of the German food delivery giant Delivery Hero. That single deal expands Uber's combined mobility and delivery footprint from 79 markets to 99 global regions. By combining these aggressive acquisitions with autonomous hardware partnerships, Uber is building a massive, pre-existing network of customers that will be ready for the fully automated era. But despite these massive investments, the transition to a driverless future is still in its earliest stages. This diagram shows the current divide. Today, robotaxis account for only about 1% of Uber's United States orders. The bullish case for Uber is that they can use their record profits today to bridge this gap, establishing themselves as the essential network for all autonomous transport. The bearish case is that they will be outpaced by dedicated autonomous technology companies or weighed down by regulatory fines and labor costs before the transition is complete. This tension is why Uber is currently trading at a historically low valuation, roughly 12 times its estimated 2027 earnings. Uber is a highly profitable, human-powered network attempting a high-speed corporate metamorphosis. It is a race to build the world's first automated logistics platform before its time or its capital runs out.